Every warning was ignored. Economists warned the market was overvalued. Bankers warned the debt levels were unsustainable. The numbers warned that prices had disconnected from reality. And ordinary investors, the people who would lose everything, they ignored every single warning and kept buying. September 1929. The stock market was at record highs. Margin debt had exploded to levels never seen before. Expert after expert was predicting collapse. And investors responded by borrowing more money to buy more stocks. Within 8 weeks, the market would crash 23% in 2 days. Within 3 years, it would fall 89%. Millions would be ruined. The Great Depression would begin. And every bit of it was predicted, warned about, and completely ignored. But the story behind it isn't what you think. This wasn't a surprise. This wasn't a black swan that nobody saw coming. The 1929 crash was one of the most predicted disasters in financial history. The warnings were everywhere. Detailed, specific, accurate warnings from credible sources. And investors, from sophisticated Wall Street professionals to small-town speculators, ignored them all. Stay tuned, because understanding why intelligent people ignore obvious warnings is the key to understanding every financial crisis, including the one building right now. In this video, we'll uncover the hidden patterns of how investors ignored every warning before the 1929 crash and why they matter today. We'll break down each stage using historical records, newspaper archives, and economic data. You'll see the specific warnings that were issued, who issued them, when they were issued, and why they were dismissed. We'll share key facts about market psychology that explain how entire populations can see disaster coming and walk straight into it anyway. And later, you'll discover the one factor that makes this pattern repeat, the specific psychological mechanism that caused 1929, caused 2008, and is operating right now in 2025. Because the warnings are being issued again, the patterns are forming again, and they're being ignored again. Just like always. Before we examine the warnings, you need to understand what ignoring warnings actually means in financial markets. It's not that people don't hear the warnings. It's not that they lack information. It's that they hear the warnings, understand them intellectually, and then continue the exact behavior the warnings say will destroy them. This is mass delusion operating at civilizational scale. And understanding the psychology behind it reveals something dark about human nature and markets. Market warnings in 1929 weren't subtle. They weren't buried in technical reports that only experts could understand. They were front-page news. Major newspapers published dire predictions. Prominent economists gave speeches warning of collapse. Federal Reserve officials expressed concern about speculation. Banking leaders cautioned about unsustainable debt levels. The information was public, accessible, and impossible to miss. And investors didn't just ignore these warnings. They actively mocked them, called the experts pessimists, accused them of not understanding the new era, dismissed them as bitter people who had missed the boom and wanted everyone else to lose. This wasn't passive ignorance. This was aggressive rejection of reality in favor of a collective delusion that had become more powerful than facts. Here's why this matters in 2025. Because the same pattern is happening right now. Experts are warning about AI bubble valuations. Margin debt is at record levels again. Price-to-earnings ratios are historically high. Economic fundamentals are disconnecting from stock prices. And investors are ignoring the warnings, calling experts pessimists, and insisting this time is different. The script hasn't changed in 96 years. The psychology behind ignoring warnings is simple and devastating. When people are making money, they don't want to hear that it will end. When everyone around them is getting rich, they don't want to be the one who pulls out too early and misses gains. When the market keeps going up, despite warnings, each day without a crash becomes proof that the warnings were wrong. This creates a feedback loop where rising prices validate ignoring warnings, which leads to more buying, which causes more rising prices, which validates ignoring even more warnings. In 1929, this feedback loop had been operating for years. The market had been climbing since 1924. Every year, experts warned it couldn't continue. Every year, it continued anyway. Every year that passed without a crash made the warnings seem more foolish. By 1929, the experts who had been warning since 1926 or 1927 looked like idiots who had missed 5 years of gains. Nobody wanted to be that person. So, when new warnings came in 1929, they were dismissed based on the track record of previous warnings that had been wrong. But those previous warnings weren't wrong. They were early. There's a critical difference. A warning that says, this behavior will lead to disaster is not proven wrong just because disaster hasn't happened yet. It's a prediction about future consequences, not present conditions. But human psychology doesn't process it that way. If you warn someone that touching a hot stove will burn them, and they touch it and don't get burned immediately because the stove takes time to heat up, they conclude your warning was wrong. Then when the stove gets hot and burns them, they act surprised. That's what happened in 1929. The warnings had been accumulating for years. Each warning that didn't immediately result in a crash was treated as evidence that crashes wouldn't happen. The fact that the market kept rising despite warnings became proof that warnings were irrelevant, and this created a dangerous situation where, the longer the bubble continued, the more invincible it seemed, and the less seriously new warnings were taken. The 1929 market had characteristics that anyone with basic financial knowledge could see were unsustainable. Stock prices had tripled between 1924 and 1929. That's a 200% gain in 5 years. Industrial production hadn't tripled. Corporate earnings hadn't tripled. The economy hadn't tripled. But stock prices had. This meant valuations were expanding far beyond underlying economic reality. The math was simple. Stocks were expensive relative to what they represented, and expensive things eventually returned to fair value. But investors had explanations for why the math didn't matter. The New Era theory, the belief that modern technology, mass production, and improved business practices had created a permanently higher plateau for stock prices, that the old rules about valuations didn't apply anymore because American business had entered a new phase where growth would continue indefinitely. This wasn't a fringe theory. This was mainstream belief among investors, journalists, and even some economists. Sound familiar? Because in 2025, the New Era theory has returned. It's called artificial intelligence, the belief that AI will transform business so fundamentally that traditional valuation metrics don't apply, that companies with no profits deserve trillion-dollar valuations, because AI changes everything, that this time really is different because the technology is unprecedented. The language has changed, but the delusion is identical. In 1929, the New Era theory provided justification for ignoring every warning. When experts pointed out that price-to-earnings ratios were at historic highs, New Era believers responded that earnings would catch up because modern business was so efficient. When experts warned that margin debt was creating systemic risk, New Era believers responded that sophisticated investors knew how to manage leverage. When experts predicted a crash, New Era believers responded that crashes were relics of the old economy before modern techniques eliminated market instability. Every warning had a counter-argument that sounded reasonable in the moment. And because the market kept rising, those counter-arguments seemed validated. This is the trap. Bubbles create their own intellectual justification. Yeah, the longer they last, the more elaborate the theories become about why they're not actually bubbles. And the more elaborate the theories, the easier it is to dismiss warnings as coming from people who don't understand the new paradigm. But reality doesn't care about paradigms. Reality cares about mathematics. And the mathematics of 1929 were clear. Stocks were expensive. Debt was excessive. The foundation was unstable. And when foundations are unstable, eventual collapse is not a possibility. It's a certainty. The only question is timing. And in 1929, multiple warnings indicated that timing was approaching fast. We're going to examine 4 categories of warnings that were issued before the 1929 crash. Expert warnings from economists and analysts who predicted the crash with remarkable accuracy. Numerical warnings from the data itself showing unsustainable conditions. Systemic warnings from the financial system showing cracks appearing. And behavioral warnings from mass psychology showing speculation had reached extremes. All 4 categories were flashing red. All 4 were ignored. And all 4 were proven right in the most devastating way possible. Let's start with the experts. The people whose job was to analyze markets and predict outcomes. the economists, analysts, and bankers who saw the crash coming and tried to warn anyone who would listen. And there were many of them, more than most people realize. The 1929 crash wasn't unpredicted. It was extensively predicted by credible experts whose warnings were dismissed as pessimism by a market that didn't want to hear bad news. September 5th, 1929. Roger Babson, and one of the most respected financial statisticians in America, gave a speech at the National Business Conference. His words were direct and terrifying. Sooner or later, a crash is coming, and it may be terrific. He predicted a 60 to 80 point decline in the stock market. He warned that the fundamentals didn't support current prices. He told investors to prepare for disaster. The market dropped immediately. They called it the Babson break. But within days, the market recovered and kept climbing. Investors dismissed his warning as the ranting of a perennial bear. 6 weeks later, the market crashed exactly as he predicted. The decline wasn't 60 to 80 points. It was 199 points in 2 months. Babson was right, but nobody listened. Babson wasn't alone. Paul Warburg, only a founding member of the Federal Reserve Board and one of the most influential bankers in America, had been warning since 1928. He wrote in March 1929 that, if the orgy of unrestrained speculation is permitted to spread, the ultimate collapse is certain to bring about a general depression involving the entire country. He specifically warned about margin buying creating systemic instability. He predicted that a crash would trigger bank failures. He was precise, detailed, and completely ignored. When his predictions came true 9 months later, it was too late for the millions who had dismissed him. Alexander Noyes, financial editor of the New York Times, wrote extensive warnings throughout 1928 and 1929. He compared current market conditions to previous bubbles that had ended in disaster. No, he pointed out that every historical instance of such rapid price increases had resulted in crashes. He documented how margin debt was creating leverage that would amplify any decline. His columns were read by hundreds of thousands of investors, and those investors kept buying because the market was still going up, because everyone around them was making money, because admitting the warnings might be right meant admitting they were in danger. The Harvard Economic Society, one of the most prestigious economic research organizations in the country, issued warnings in early 1929. They analyzed business cycle data and concluded the market was disconnected from economic reality. They warned that a correction was inevitable and likely to be severe. They recommended caution and profit-taking. Investors accused them of academic pessimism, of not understanding real-world market dynamics, of being jealous of people making money. The Harvard economists were ignored, and when the crash came, their predictions were vindicated, but their warnings had saved no one because no one had listened. Even some Wall Street insiders were warning. Joseph Stagg Lawrence, a Princeton economics professor who had extensive Wall Street connections, wrote in 1929 that the market had entered a phase of sheer insanity. He documented how prices had lost all connection to underlying value. He showed how margin debt had created a house of cards. He predicted that when the decline started, it would be catastrophic because forced margin selling would accelerate the crash. He was exactly right, but investors didn't want analysis. They wanted validation of their decision to stay in the market. And the Federal Reserve itself was issuing warnings, though more subtly. Throughout 1928 and 1929, the Fed raised interest rates multiple times, trying to cool speculation. They understood that cheap money was fueling unsustainable stock buying. They tried to restrict credit for speculative purposes, but their efforts were overwhelmed by the sheer volume of money flowing into stocks, and their concerns were dismissed by market participants who saw rising rates as a sign of economic strength rather than a warning about speculation. Here's what makes these warnings so significant. They weren't vague predictions. They weren't general caution about markets always having risk. These were specific, detailed warnings about current conditions leading to imminent catastrophe. Babson predicted the timing within weeks. Warburg predicted the mechanism of the crash. Noyes predicted the severity. The Harvard economists predicted the economic consequences. These weren't wild guesses. These were informed analyses from experts with decades of experience and access to comprehensive data. And investors had detailed counter-arguments for dismissing each expert. Babson was a known bear who had been predicting crashes for years. Warburg was old-fashioned and didn't understand modern market techniques. Noyes was a journalist, not an investor, and thus didn't have real market experience. The Harvard economists were academics disconnected from the real world of business. Every expert had some characteristic that allowed investors to dismiss their warnings without addressing the substance of the warnings themselves. This is how human psychology deals with unwelcome information. Attack the messenger, question their motives, find reasons to ignore them that don't require engaging with their actual arguments. Because engaging with the arguments meant confronting uncomfortable truths. It meant admitting you were in danger. It meant considering selling and missing out on potential gains if the market kept rising. So, it was psychologically easier to dismiss the experts as pessimists, bears, or people who didn't understand the new era. But the experts kept warning. As summer 1929 progressed, the warnings became more urgent and more specific. In August, financial journals were publishing articles about unsustainable speculation. In early September, multiple economists were predicting imminent correction. By mid-September, and even some brokerage houses were advising caution to their clients. The drumbeat of warnings was constant and growing louder, and the market kept climbing because enough investors were convinced this time was different. The most devastating aspect of these ignored expert warnings is how accurate they were. Babson predicted a crash within months. It happened in weeks. Warburg predicted bank failures following a market crash. Over 9,000 banks failed in the subsequent years. Noyes predicted a severe correction. The market fell 89%. The Harvard economists predicted broad economic depression. The worst depression in American history followed. These weren't wrong predictions that happened to coincide with random bad luck. These were correct analyses of unstable conditions that inevitably led to the predicted outcomes. Here's how insane the margin debt had become. In 1920, margin debt was under $1 billion. By 1929, it was $8.5 billion, an 8.5x increase in 9 years. The stock market had tripled in that time, so some increase in margin debt made sense. But an 8.5x increase meant that leverage was growing much faster than the underlying market. More and more of the buying was debt-funded. More and more investors were betting with borrowed money. And every dollar of borrowed money was a dollar that would need to be paid back, regardless of what happened to stock prices. The agricultural economy was collapsing while the stock market soared. This was a fundamental disconnect that the numbers made obvious. Farm income had been declining since 1925. By 1929, farmers were in serious financial distress. Agricultural prices were falling. Farm foreclosures were increasing. Rural banks were failing. This represented a huge portion of the American economy, and it was contracting while stock prices were exploding. The economic foundation of the country was weakening while investors were acting like prosperity was unlimited. The numbers showed it clearly. Farmers couldn't afford to buy the products that industrial companies were producing, which meant those companies' earnings would eventually decline, which meant stock prices were based on unsustainable assumptions. Industrial production itself was showing warning signs by mid-1929. After years of growth, production started plateauing and then declining slightly in summer 1929. Steel production, a key indicator of overall economic activity, peaked in June 1929 and began falling. Automobile production peaked in March 1929 and declined afterward. Construction activity was slowing. These were leading indicators that the economic expansion was ending, and they appeared months before the stock market crash. The data was public. Factory output numbers were published regularly. Investors could see that the economic engine driving corporate profits was sputtering, but stock prices kept rising because investors believed the stock market was independent from the underlying economy. It wasn't. Consumer debt was reaching dangerous levels. Americans had discovered installment buying. Buy now, pay later. This created artificial demand. People could purchase cars, appliances, furniture, radios, all on credit. This drove corporate sales and profits in the short term, but it was pulling future demand into the present. Once consumers were fully leveraged, once they had bought everything they could afford to buy on credit, demand would collapse. And by 1929, consumer debt levels suggested that saturation point was approaching. The numbers showed consumers were tapped out, but companies kept producing as if demand would continue indefinitely, and investors kept buying stocks based on that production. The velocity of speculation was measurable. Trading volume had exploded. On an average day in 1925, about 2 million shares traded on the New York Stock Exchange. By 1929, average daily volume was 4 to 5 million shares. On big days, volume reached 8 to 10 million shares. More trading meant more speculation, more people trying to profit from price movements rather than investing based on fundamental value, and you could see it in the numbers. Stock ownership had shifted from long-term investors to short-term speculators. Average holding periods had shortened, turnover had accelerated, the market had become a casino, and the numbers proved it. The distribution of stock ownership showed dangerous concentration. About 1.5 million Americans owned stocks in 1929. That's less than 2% of the population. But those 1.5 million people controlled a disproportionate amount of wealth. And within that group, ownership was concentrated further. A small percentage of very wealthy individuals and institutions held most of the stock. This created fragility. If a relatively small number of large holders decided to sell, there weren't enough buyers to absorb the selling. The market stability depended on a tiny fraction of the population continuing to believe prices would rise. The numbers showed how unstable this was, but investors assumed there would always be buyers. Foreign investment flows were another numerical warning. European investors had been buying American stocks heavily in the mid-1920s, but by 1928 and 1929, that flow was reversing. European economies were struggling. They needed capital at home. They started selling American stocks and repatriating the money. This reduced buying pressure in the U.S. market. It also meant gold was flowing out of the United States back to Europe. Gold flows are important because they indicate capital flows, and capital was leaving. The numbers showed it clearly. International investors were reducing their U.S. exposure. That should have been a warning to domestic investors. It wasn't. Corporate insider selling was accelerating. Company executives and directors were selling their own company's stock. They had better information about their businesses than outside investors did, and they were selling. The numbers on insider transactions were public. Major newspapers published them. Investors could see that the people who knew the companies best were taking profits. But small investors interpreted this as the insiders being foolish and missing continued gains. In reality, the insiders understood that valuations had become unsustainable and were getting out while they could. The yield on stocks versus bonds was another screaming warning. Historically, stocks yielded more than bonds because stocks were riskier. You demanded higher returns for taking higher risk. But by 1929, stock dividend yields had fallen to around 3%. High-quality corporate bonds were yielding 5 to 6%. This meant bonds were paying nearly twice what stocks paid, and bonds were safer. The only reason to prefer stocks at those yields was if you expected substantial price appreciation. You were betting on prices continuing to rise, not on earning income from dividends. This showed that investors weren't buying stocks for investment. They were buying for speculation. The numbers made it obvious. Every numerical warning had a rationalization. High P/E ratios, earnings would grow into them. Massive margin debt, sophisticated investors could manage leverage. Agricultural depression, farmers were a declining portion of the economy anyway. Declining industrial production, just a temporary pause before resumption of growth. Consumer debt saturation. Americans had rising incomes to support payments, decreased foreign buying, domestic investors had plenty of capital. Insider selling, they were being foolish and overly cautious. Low stock yields, price appreciation would make up for it. Every warning had an excuse. Every red flag had an explanation. And the explanations all shared one theme. This time is different. The old rules don't apply. Modern techniques, modern business practices, modern financial instruments have changed the game. The numbers that would have warned investors in previous eras don't mean the same thing now. We've entered a new paradigm where stocks can be more expensive, leverage can be higher, and warning signs can be ignored because the underlying conditions have fundamentally changed. But the underlying conditions hadn't changed. Mathematics hadn't changed. If prices triple and earnings don't, stocks become expensive. If investors borrow too much, they become vulnerable. If the economy weakens, corporate profits fall. If insiders sell, it means something. These relationships are fundamental. They don't stop working because investors want to believe they've stopped working. And in 1929, all the numbers were pointing in the same direction, toward unsustainability, toward instability, toward inevitable correction. The numbers were impossible to justify, but they were ignored anyway. And the numbers weren't the only warning, because beyond expert predictions and mathematical impossibilities, the financial system itself was breaking down. Banks were failing. Credit was tightening. International economic problems were spreading. The infrastructure that supported the market was showing cracks. And those systemic warnings were just as clear and just as ignored as everything else. The banking system was already cracking before the stock market crashed. Small banks across America, particularly in agricultural regions, had been failing since the mid-1920s. Between 1923 and 1929, over 5,000 banks failed. 5,000. These weren't tiny institutions. They were community banks that served farmers, small businesses, local economies. Their failures indicated that the economic foundation beneath the stock market boom was unstable, but urban investors barely noticed. Rural bank failures seemed irrelevant to the booming industrial stock market, until they weren't. The Federal Reserve was issuing warnings through its actions. Throughout 1928 and 1929, the Fed raised interest rates repeatedly. The discount rate went from 3.5% in early 1928 to 6% by August 1929. That's a massive increase in a short period. The Fed was trying to cool speculation by making borrowing more expensive, but their efforts were overwhelmed. Investors borrowed anyway because they expected stock gains to far exceed borrowing costs, and the Fed's actions themselves became a warning. When a central bank is aggressively raising rates, it means they see danger. The market ignored the signal. European economic problems were accelerating in 1928 and 1929. Germany was struggling with reparations payments from World War I. Britain was dealing with economic stagnation. France was managing political and economic instability. These weren't minor issues. These were major economies showing serious stress. And European problems mattered because the global economy was interconnected. American banks had significant European exposure. American companies sold products to Europe. European investors owned American stocks. When Europe weakened, it affected America. The warning was clear, but American investors believed they were insulated from foreign problems. The gold standard was creating pressure. Gold was flowing out of the United States to Europe in 1928 and 1929. This happened because European economies needed gold reserves, and American interest rates, despite Fed increases, were still relatively low compared to returns available in the stock market. Gold outflows meant the U.S. money supply should contract, but it didn't contract enough because banks were creating credit to fund stock speculation. This created a tension between monetary discipline and speculative excess. Eventually, that tension would snap. The gold flows were a warning. Nobody paid attention. Investment trusts were the 1920s equivalent of modern derivatives. They were companies whose only business was owning stock in other companies, and they were wildly popular. By 1929, there were hundreds of investment trusts with billions in assets. Investors bought shares in these trusts, which used that money to buy stocks, often using leverage. So investors were leveraged, trusts were leveraged, and the underlying stocks might be in companies that were themselves using debt. Multiple layers of leverage built on top of each other. The system was a house of cards. Financial experts warned about this structure. They explained how leverage multiplied risk at every level. And investors poured money into investment trusts because they were making spectacular returns, until they weren't. But the most telling warning wasn't from experts or numbers or systemic cracks. It was from behavior itself, from the mass psychology that had gripped the nation, from the sheer insanity of how ordinary people were acting in summer and fall 1929. This behavioral warning was the most obvious and the most ignored of all. Everyone was in the market. Doctors, lawyers, teachers, factory workers, shop clerks, taxi drivers. People who had never invested before were opening brokerage accounts. People who had no understanding of business or finance were buying stocks on margin. The shoeshine boy giving stock tips became a famous cliche because it actually happened. When everyone from professionals to manual laborers is speculating in stocks, that's not normal investment activity. That's mania. And throughout history, manias end badly, always, without exception. Margin buying had reached insane levels by September 1929. People were borrowing 90% of the purchase price of stocks. Put down $10, borrow $90, buy $100 worth of stock. If the stock went up 10%, you doubled your money. But if it went down 10%, you were wiped out. And people weren't buying one stock with borrowed money. They were buying portfolios of stocks, all with maximum leverage. Entire life savings were being committed to markets that could move 5% in a day. The risk was astronomical, the potential for total ruin was obvious, and people rushed to take on more risk because their neighbors were making money doing it. Get-rich-quick schemes were everywhere. Books about how to make a fortune in stocks were bestsellers. Newspapers ran columns with stock tips. Investment seminars promised to teach ordinary people how to beat the market. The promise was always the same. Anyone could get rich. You just needed to buy stocks. It didn't matter which stocks. It didn't matter if you understood the companies. It didn't matter if prices made sense. Just buy and watch your wealth grow. This kind of thinking pervades every bubble, and it always leads to disaster. Financial literacy was near zero, but confidence was maximum. People who couldn't explain what a stock actually represented were convinced they knew when to buy and sell. People who had never read a financial statement were certain they could identify good companies. People who didn't understand margin debt were borrowing massive sums. The combination of ignorance and confidence is lethal, and it was universal in summer 1929. Nobody thought they needed to understand markets. They just needed to follow the crowd, and the crowd was making money. Until the crowd tried to sell. The final weeks before the crash were manic. September 1929 saw some of the highest prices ever recorded. But volatility was increasing. The market would jump 3% one day and fall 2% the next. These swings should have terrified investors. Instead, they were seen as buying opportunities. Every dip was a chance to acquire stocks before they resumed climbing. The belief that stocks could only go up had become unshakable, even when the market started showing instability. Investors interpreted it as temporary turbulence before continued gains. Then came October. The month started with optimism. Some weakness in late September had been bought. The market seemed stable, but on October 18th, the market fell, then recovered, then fell again on October 23rd. Then came October 24th. Black Thursday. Panic selling overwhelmed the exchange. 12.9 million shares traded, nearly triple the normal volume. Prices collapsed. Major bankers stepped in to support the market. They bought stocks to stem the panic. It worked temporarily. The market stabilized. Newspapers proclaimed the crisis was over. Investors who had sold felt foolish. But the bankers' intervention only delayed the inevitable. On Monday, October 28th, the market fell 13%. Black Monday, the worst day in stock market history up to that point. And then came Tuesday, October 29th, Black Tuesday. The market fell another 12%. In 2 days, the market lost 23% of its value. 23% in 2 days. Margin calls cascaded. Brokers sold out positions. Investors watched their wealth evaporate. The crash was underway, and it didn't stop. Over the next 3 years, the market fell 89% from its peak. 89%. The Dow Jones Industrial Average went from 381 in September 1929 to 41 in July 1932. Companies that seemed invincible went bankrupt. Investment trusts collapsed. Banks failed by the thousands. Investors who had been millionaires on paper in September 1929 were destitute by 1932. Suicide rates spiked. Families were ruined. The Great Depression began, and every bit of it had been warned about. Babson had warned and was dismissed. Warburg had warned and was ignored. The numbers had screamed warnings and were rationalized away. The system had shown cracks and was overlooked. Mass psychology had reached extremes and was celebrated. Every warning sign was present. Every danger signal was flashing. And investors chose to believe this time was different, that modern markets had evolved beyond the risks that destroyed previous generations. They were wrong, catastrophically wrong, and millions paid the price. Here's what makes the 1929 crash so relevant in 2025. Because the exact same pattern is developing right now. Expert warnings are being issued about overvalued markets. The numbers show valuations at historic extremes. The system is showing cracks with regional bank failures and credit problems. Mass psychology has reached manic levels, with retail investors piling into AI stocks and meme stocks using leverage. And all these warnings are being dismissed with the same arguments used in 1929. This time is different. AI is transformative. Modern financial systems are more sophisticated. Central banks won't allow a crash. We've learned from history, but we haven't learned from history. The lesson of 1929 isn't that crashes happen. It's that crashes happen despite obvious warnings. It's that intelligent people can see disaster coming and walk into it anyway because they don't want to miss potential gains. It's that crowds can maintain delusions longer than rational analysis suggests is possible. It's that every bubble creates justifications for why it's not a bubble. And those justifications seem convincing right up until they're proven disastrously wrong. The warnings in 2025 are as clear as they were in 1929. Valuations are stretched beyond historical norms. AI companies are priced for perfection with no room for disappointment. Margin debt is at record levels. Retail participation has exploded with trading apps making speculation accessible to everyone. The parallels are undeniable. But just like 1929, the warnings are being ignored. Because prices keep going up. Because everyone around you is making money. Because you don't want to be the person who sells too early and misses gains. The pattern repeats because human psychology doesn't change. Fear of missing out is more powerful than fear of losing money. The pain of watching others get rich while you stay safe is worse than the pain of losing money after everyone else loses too. So, investors ignore warnings, follow the crowd, and hope they'll be able to get out before the crash. But that's impossible. Because in a crash, everyone tries to get out at the same time, and there are no buyers when everyone wants to sell. The 1929 crash destroyed fortunes and lives, but it also provided clear lessons. When experts warn, listen. When numbers show unsustainability, believe them. When systems show cracks, take them seriously. When mass psychology reaches extremes, be afraid. These lessons were learned at tremendous cost, and they're being forgotten again. Because it's been long enough since the last major crash that a new generation believes they're smarter than previous generations. That they understand risk better, that they can time markets more effectively. They can't. Nobody can. And the warnings being ignored today will be proven right just like the warnings ignored in 1929. If you want to understand the warnings being issued right now, if you want to see the parallels between 1929 and 2025, if you want to avoid being the person who ignores obvious danger signals, subscribe to this channel. Hit the notification bell, because we're going to continue documenting the warnings. We're going to track the data. We're going to show you the same patterns that preceded every major crash in history, forming again in real time. The next video will cover how investors ignored warnings before the 2008 financial crisis. You'll see that the same pattern repeated. Experts warned. Numbers showed danger. The system showed cracks. Mass psychology reached extremes, and investors ignored everything and lost trillions, because the pattern never changes. Only the details change. The fundamental human psychology that drives bubbles and crashes is constant across time. Subscribe and stay informed, because the warnings are here, the patterns are forming, and understanding history doesn't guarantee you'll avoid the crash, but ignoring history guarantees you won't.